Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
Welcome, everyone. You're listening to Your Money Momentum. This is our mid-month podcast. My name is Tom Kennedy, and I have Kevin Curley here, and we are going to kick it off with a new segment. So for a mid-month podcast, we're going to do 5 good minutes of financial planning, and we're going to break this down every other podcast and go over financial planning topics. The first one is going to be around tax strategies. So we'll jump into that. We'll do some role playing, and then we'll end up with our last segment, the central bank roundup. So let's jump into it. Kevin, let's talk about our new topic, financial planning in regards to tax strategy.
Yeah, I think that the big elephant in the room is that there was a tax cut passed during the Trump administration, commonly called the Trump tax cuts, and it expires soon. A year and a half or so, we really got to get some planning done because at the end of 2025, everybody's tax rate's going up. There's a lot happening in there. So just as a reminder, some major changes took place. We got a higher standard deduction. Tax rates for everybody went down. The estate tax went down. Mortgage interest changed. The SALT caps changed. Corporate taxes actually got cut lower, and those are permanent for some reason, while individuals was temporary. So I think it's very important to talk about tax strategies to reduce that, but even more so over the next couple of years in anticipation of everybody's rates going higher. So just one thing, I would say the top rate goes from 37% to 39.6%. Everybody else is going to go up a few percent as well. So I think it's essential to find ways to defer or reduce your tax burden going forward.
Okay, so let's break it down to a couple big ones that's going to affect everyday consumer, listener, etc. So we got top tax rates going up. We knew that was coming. What else do you see out there that's going to catch people off guard when this sunsets at the end of 2025?
Yeah, the big thing is the standard deduction. So if you're not itemizing, and it doesn't make sense for the majority of people to itemize, it's the small percentage, and probably many of our clients do itemize, but right now for 2023, the standard deduction for a couple is $27,700. Once these expire, that deduction goes down to $12,700. So more than cut in half. That's a pretty big drop to have suddenly about $15,000 more included as taxable income. And if you're getting taxed at 20 or 30%, that's a few $1,000s you're going to be paying. The second thing would be the cap that was placed on the state and local tax deductions, so commonly known as SALT, was capped at $10,000. Once the Trump tax cuts go away, that cap no longer applies, but there's phase outs for people who have like a few $100,000. That deduction goes away as well. So there's a lot of things you can do. So the first thing I would say is in 2025, you can use the standard deduction and you could wait to pay your property taxes. So if you live in Texas, average 2.7% for your property tax. Let's say you're paying $10,000 now. Well, you could stack those tax payments all in the following year. So you typically get your bill sometime in the fall, maybe October, November, and it's due by the end of January of the following year. You could pay it in January of 2026 for the first time and pay the second year, so for 2027, at the end of 2026. And the benefit of that is if that SALT deduction goes away, you're going to get a much higher deduction, and it'll make a lot more sense to itemize since the standard deduction is going to go from almost $30,000 down to $13,000.
So what else can we be doing? So that's at the end of 2025. What do we start doing now to prepare for taxes?
Well, it depends. So if you're a very wealthy family, state taxes are going to jump. So you need to start getting that exemption now. So if the exemption is going to go down a significant amount after 2025, you need to go ahead and do your tax planning now, complete those gifts, get that out of your estate. That way you're not taxed on otherwise. If you're somebody that has a mortgage, good news. You might want to cash out refinance after 2025 because instead of being capped at $750 of principal on qualified debt, it goes back to $1 million, which is where it used to be before that. And if you had home equity interest, that was reduce now, it'll go back to get the first 100,000 of that debt is actually deductible for the interest payment. So, there's a chance for you to suddenly go, oh, wow, my whole picture is going to change of what I should be doing to minimize the amount of taxes and maximize my deductions.
I think the one time sensitive one that you mentioned are estate taxes. So as it sits right now, an individual their lifetime exemption amount is 10 million. Well, actually, it's over 10 million because it goes up with inflation. Let's call it 12 million. If you're married filing jointly, it's 24 million. Meaning, if you have $100 million estate and you pass away today, 24 million is exempt from estate taxes. The other
A lot of money.
76 million is going to the IRS at a rate of 40% over that lifetime exemption amount. When this tax rule sunsets at the end of 2025, it's going to go back down to 5 million per individual. So married filing jointly, it goes back down to 10 million. Now, many of you listening, that might not be an issue right now, but it could be an issue down the road. If you have a couple $1 million saved up in a 401k or any other investment accounts, as that continues to grow, it's going to be subject to estate taxes down the road. And that's probably not going to be going down. It's probably only going to be going up, those taxes. So what Kevin is saying is you can start to gift those assets away now, because it's going to go back down to that $5 million level per individual. So if you have room left, it's better to gift that now in the event that it does drop back down. So I think that if you fall in that category, you need to start planning sooner than later before this expires. I think that's the biggest time sensitive tax issue I see coming up in the next 2 years.
Yeah, I think that's the biggest hanging fruit out there is to go get that one and make sure you complete those gifts now. And you can still have control of those gifts if you plan it in a very thoughtful way. You're not just giving away the money directly. And so you can give it to a trust and then maybe they inherit it a little bit later. But it's got to be a completed gift to your estate. And that way you get that. It's also, Tom, who's in charge at the time of these expirations is probably going to have a big impact on which parts of this get extended and which parts of these just expire. So depending on who's in charge of Congress, you could see certain tax brackets get hit a lot harder than others. You could see certain credits get increased or decreased. So it's a moving target for sure. But based on today's rules, I think number one is the estate tax, but just planning out your debt when it comes to mortgage deductions and then planning out your itemized deductions. So if you're going to make a big charitable gift, doesn't make sense to do it in 24, 25, or wait until 26 when tax rates are higher so you maximize deduction now. So this is something Tom can help you with and the other advisors at Global Wealth.
Yep. Nope. I agree. So we'll touch more on some different tax strategies as we get closer. But I think that's a good start. And for those of you that want more information or have more questions, you can shoot us an email at info@gwadvisors.net, because there's a lot in the proposal and there's a lot that's going to, possibly expire within the next 2 years. So we want to make sure we're preparing now for that, so we're not caught off guard when that does happen.
All right. Get ready for some role play. All right, Tom, you want to go first or second?
I'll go first.
All right. So, Tom, you are Brian Moynihan, the CEO of Bank of America. You just failed the stress test for the Fed, but then said, well, it was just a discrepancy. We didn't really fail. But it caused you to delay a dividend while all the other major banks did not have to do a delay. What went wrong?
Well, one, I don't know if that's 100% accurate. The Fed said that they did have enough capital to be solvent, but there are some discrepancies on their, I guess, balance sheet or their reporting. So I don't know. I don't know what went wrong. I would argue that we're okay. I would also argue that cutting the dividend, there's a lot of uncertainty for the banks right now. There's a lot of headwind. You have an inverted yield curve. They're not making nearly as much money as they were. And if I'm a big bank, I want to have some dry powder on hand to acquire some smaller ones as others start to pop up insolvent, in my opinion. So I don't know if anything, I don't think there's too much to worry about insolvency right now with the big banks, even with that stress test. I think it's more of a strategic play by cutting that dividend.
Do you think that the unrealized losses on the bond portfolio are a problem, or Fed's just
Y-
going to bail you out of those?
Oh, 100%. I mean, that's their
You're getting
that's
bailed out.
for sure. There's no way they bailed us out in 2008, and now they're not going to bail us out now. They just bailed out a couple of regionals. We're in a good spot.
Yeah, you're number one. So that $52 billion loss, they'll just go ahead and put that on the Fed balance sheet instead of yours. That sounds
Just
great.
just just an IOU, just moving from one column to the next. All right, Kevin. So you are Jose Garcia, CFO of Santander. You just paid a 200
Santander, sir.
Santander. You just paid a 224 million euros in a windfall profit tax.
Yeah, Tom, I got to tell you, these socialists who run our government over here in Spain, they're out of control. They're just singling us out. We're one industry. There's so many industries that Spain has to offer. There's all these other industries, but yet they only come after us, the banks. We are doing our best. We had losses as previously. Now we're growing, got 10% growth in our profits, and they just take it from us. They paid 224 million euros for what? For doing the right thing and running our bank properly. What am I supposed to do? I just want fair play. I'll pay my taxes, but make everybody else's industry. What about all these other industries? They don't pay any windfall taxes. Why is it just the banks? What do we do wrong?
Well, what about the oil and gas companies? They're paying their fair share, aren't they?
Okay, so 2 out of 12 industries. What about the other 10? Where's their windfall profit tax?
Well, listen,
I'm
we don't
taking
want.
this to court, to the highest court of Spain, and we're going to get this thing overturned.
All right.
All right, Tom, you're Jerome Powell, chair of the Federal Reserve. Was this a pause, actually a stop? Are you done raising rates? Is the dollar going to fall now that you're done raising rates? What do we expect from you next?
I am gonna continue to raise rates. I've gotten it wrong the whole entire time on the way up. I'm gonna get it wrong the whole entire way on the way down. There's no reason for me to pause right now. You have the markets almost hitting a new all-time high, or at least a 52-week high. You have unemployment still well below where I want to see it. You have inflation way too elevated, in particular core inflation. There's only one way to stop this. Everyone obviously knows that raising rates does stop inflation, and it will cause a soft landing. So I'm going to continue to hike rates at least 2 to 3 more times this year. Everyone thinks I'm going to pause, and that's just not going to be the case.
I look forward to seeing you thread the needle.
All right, Kevin. So you're up. You are Mike Decker. Who is Mike Decker?
I'm the vice president of the AICPA. You've never heard of me?
Well, I guess I have now. Only 67,000 people took CPA exams last year, down from 72,000 in 21 and below your own forecast. The numbers are trending towards 20% lower than the past decade. What is happening in the accounting world, and why does no one want to be a CPA?
Well, Tom, it's actually a pretty simple math question. It's a little concept called ROI, return on investment. And it turns out that we don't pay that well in accounting compared to technology or finance jobs. And so a lot of the smart kids who could pass our exams are just choosing a different career. They want to make more money, and those salaries are inflated over there, but they're coming back. They're going to have to come back. Accounting is the backbone of finance. It's the backbone of the economy. Without accountants, we wouldn't know what the numbers are. We wouldn't be able to make any decisions. We think that things will be okay. And plus, with this AI GPT, it's going to be fine because we'll automate some things, and we they have to understand accounting is very important. It's not a crisis. We're going to be fine. It doesn't matter that there's only 80% as many CPAs taking the test as there were a decade ago. It doesn't matter that the profession plunged to the lowest level of people entering it in the last 17 years. We're important. We're going to be here. And it's gonna bounce back. It's gonna be fine. This is just demographics. This is fine.
Yeah, I disagree. I don't think you guys are all that useful, to be honest with you, unless you're doing creative accounting, which
Those creative accountants are all in jail, Tom.
the creative accounting, well, the good ones aren't. They're the ones that don't get caught on the corporate side. Might might do well, but everything else is automated. So I don't know. I think TurboTax is doing just fine with most returns, but we'll see. All right, let's move on to our last segment, central bank roundup.
Shine those boots. It's time for
Ďaľge.
Central Bank Roundup.
All right, we kick it off with the Bank of Germany, known as Bundesbank. It took $1 billion hit from its bond holdings. It is struggling the same way Bank of America and all the other banks are. They're sitting there holding the bag as interest rates rise on a bunch of bonds that are suddenly worth a lot less. The ECB going to have to bail them out, Tom. I don't know what they're going to do here. This is just kind of funny, right? People in charge are causing losses, and they bought 666 billion euros of German government debt last year, and they have losses on all of it because interest rates rose. And you kind of just go, well, yeah, of course they did.
Yeah, well, they all shot themselves in their own foot. I mean, you had 15 years of zero interest rates, and you had a ton of debt issuance, and then the biggest catalyst I saw years ago for why rates will not go as high as they are right now, I never thought they would even get as high as they are right now, is for that very reason alone, is that these central banks would put themselves into bankruptcy if they raise rates too much, just because the interest carry alone on this debt should do that. But I also forgot that, they have a blank checkbook and will just continue to bail themselves out. What else are they going to do? Default?
So they write IOUs. That's how they do it.
They write IOUs, yeah.
So they did this in the 70s, and they said that they basically were like, look, these losses, this is temporary. This will go away. We'll just deduct it against future profits 10 or 15 years from now. So they still have 170 billion of gold and foreign exchange reserves. And then they said they'd carry the losses forward. What's funny is that in Berlin, they have the same thing going on as in the US. So the Treasury Department for the last few years has basically got, I don't want to call it interest payments, but they've gotten money they didn't earn from the Fed saying, hey, we had profits this year, and they give it back to the Treasury. Well, because of the losses they're having now, they're not going to give that to the Treasury. So the Treasury is going to have to be funded some other way or cut its expenses. So are they going to have fiscal reform? Are they going to go get more fines? It's just funny to see it happening somewhere else, which is Germany's got the exact same thing. Supposed to be a much more disciplined, central bank, supposedly better leaders than the U.S., and they had the same problem we have, and it's all from rising rates.
Yeah, I don't think it's going to get any better anytime soon, and I don't even think it really has even trickled into the economy yet because of how quickly they've gone up. So the big question that we were joking about earlier, does he continue to raise rates? I don't even think that's relevant at this point, because if he does, it might be one or two more times. It's how long does he keep those rates elevated for? If we fast forward 12 months and we're still at where we're at right now, over 5% on the Fed funds rate, I think it's going to be bad, and it will get bad, and then they'll have no choice but to lower rates. But yeah, there's a lot of countries I think that are in the same. We have a global debt problem right now, global sovereign debt problem. Remember, 3 years ago there was $17 trillion in sovereign debt with negative yields. Now you got interest rates that are not only not negative, but they're up 5%. It's crazy to think about how quickly that reversed. We were just talking about negative sovereign debt yields only 3.5 years ago, and it was 17 trillion around the world. Now everyone is up, 5,000 basis points from then.
Yeah, a lot of these are paper losses, just like the banks. So we'll see what happens. So the next one is the question of dollar dominance. So central banks, we've talked about in previous episodes for the past year, have been the major driver for buying gold. They've all been trying to diversify away from the dollar. Well, thankfully, somebody did a survey and asked all the central bankers what they plan to do next. So today, as we mentioned before, 58% of the foreign reserves held at other central banks are U.S. dollars. That number is down from 70% where it was 20 years ago. But they said their expectations going forward is in 10 years, so 2033, they expect it still to be 54%. So even though it's smaller than it used to be, 54% of all foreign exchange reserves are going to be held in U.S. dollars. I don't think it's going anywhere, right?
No, I don't think it is either. I mean, where else is it? Where else is going to go? I mean, this has been going on for years. I don't think it's going away anytime soon. I think the dollar has peaked out. I mean, you saw the run up last year, which was a big reason. You know, we talked about this before between the inverse correlation between the stock market and the dollar, and that has decoupled a little bit, and the dollar has kind of just somewhat flatlined since the beginning of the year. So I don't see much movement, nor do I see it losing its dominance, unless, like I've said before, the U.S. just starts to default on its debt. And
Hey, we almost did 2 months ago.
and we could. I mean, that amount just keeps growing, and it's going to continue. It's like pouring gasoline on the fire when now you have interest rates at 5% versus zero, and you have to pay that interest somehow. It's just going to keep mounting and mounting.
They're
Couple
kind of
that with
stuck. Like, well, yes, go ahead.
No, I was gonna couple that with just demographics. People are living longer. You have Social Security, Medicare, Medicaid. I mean, that's some of the biggest contributors to our social plans and our debt. It's everything is. I don't see how we get out of this debt issue, and that should, like any other company that's insolvent or has a lot of debt, um, starts to get downgraded, and that's the only way, in my opinion, that the dollar uses its dominance is if we start to get downgraded. But then again, if we're getting downgraded, what other currency is going to step in? I don't know.
Yeah, well, that's a good point to kind of finish on, which is the study also found only 13% of respondents said they expected to increase their holdings of Chinese currency. So that's down from last year where it was 30%. They go from a really small number. They're only 3% of reserves right now. So if they got to, 4 or 5 or 6, that's a considerable amount more. But if 10 years from now, the Chinese currency makes up 6% of foreign reserves and the US is 54% and the euro is 20%, and then gold and other hodgepodge of stuff makes up the rest, the US is still going to be kind of the only game in town, or at least the most dominant player in town.
Yeah, no,
Good to be American.
I agree. We're the cleanest shirt in a basket of dirty laundry.
All right. Well, let's go stay in Asia, sort of, as we finish with Japan. The Bank of Japan is getting pretty close to a spot where they previously intervened in their currency against the dollar. So, the end of kind of 2022, October around then, they did a currency intervention to fix it, and they went from 150 per dollar back to 130 through that intervention, and that worked for a while. But now it's trending back to the mid 140s on yen to dollars. I think if it gets back to 150, they've kind of made it clear that 144, 147, that's where they start to get involved. If it goes past 150, I think they have to do something, right?
Yeah, no, I agree with you. I don't think they'll let it get past 150. They haven't. I don't think they will. I mean, they've been keeping their interest rates in a very, very tight range for a very, very long time, and they're going to continue to do that with their currency.
Yeah. Yeah. I mean, they did like, so October of last year, what was interesting about that, it was kind of the peak in rates uh, for a little while, and it was kind of the bottom of the markets. And I think a lot of it was they dumped $65 billion of foreign reserves just on the market to defend the yen. And so if they do that again, maybe you get another leg up in the rest of the markets here.
Yeah, I mean, it peaked out in what looks like it was October of last year. Got right up to
Mhm.
about 150. So, yeah, it'll be interesting it'll be interesting to see what these central banks all do. It's almost like a game of chicken. Who's going to be the first one to stop or actually even cut rates? I don't think. I think. I think they're all waiting for someone else to do it and see the impact that it has. It's just
Yeah.
like
Well, they were all doing the Fed, and then the Fed stopped, and now the ECB says they're going to keep going, and then the Bank of England is in the worst spot. They have allegedly, based on their commentators, no credibility, and they're going to have to raise rates. At least the Fed has some credibility that they might do it to where they're threatening and their jawboning has an effect. The Bank of England has no effect with their jawboning, and so they have to raise rates because their jawboning just doesn't work.
Yeah, and you know what? I think the job owning here is becoming less and less impactful. I think the market has kind of grown callous to it. I mean, the fact that it was just in March, right before the whole regional bank debacle. They were saying not only are they not raising, but they're going to cut 2 to even 3 times before year's end. And now we're talking about, nope, it was just a pause and we're going to raise possibly 2 more times. And the market keeps going up. This time last year, the market never reacts twice on the same news. And this is old news, raising rates. So that's why I said I think it's almost irrelevant them raising rates. It's just how long do they keep it there how much destruction do they really, really want to see? And it's not helping us and when I say us, those in the camp that don't want them to raise rates, with the market just continuing to go higher and higher. I mean, the Fed, whatever they say and do, the market is just ignoring it, which you haven't seen that in a while, in my opinion.
Well, I think they think that the battle's over and we're on to what they call the last mile or the end game, right? Which is part of the reason they pause to say, look, inflation went from 8, now it's down to 6, now it's down to 4. If we can just get a little bit lower. So we've kind of talked before of whether or not they're just going to declare victory when they get to 3 or 4 and say, that's good enough, or if they're going to really push for that last mile to get under 2. And I do think it'll take a little bit more in the absence of fiscal changes. Unless you cut government spending by a significant amount to cut the inflation rate that way, they're going to have to keep rates higher a little bit longer. But I'll be curious to see when they get to that 2, do they just pause or do they cut immediately? Okay, now growth's weak. We need to get that going, even though we solved inflation. So,
it'll
be a good show.
Jeff Gunlack said it best. He's like, what world do they think that inflation is just going to magically stop at 2%? He goes, if it's going to continue to drop, what's it to drop right to 0? They're not just going to be able to stop it right at 2%. And I agree with them. And why is even 2% the number? And we've talked about this before. So, and I don't think they have I know they don't have answers to any of those questions.
The short answer is they want a little bit of inflation. I think 2 is arbitrary. They just want something more than 0. And the reason why is it kind of greases the skids of economic growth. Because if you and I go into a deflationary world and every day products get a little cheaper, well, you're just going to keep waiting to buy and waiting to buy. So if they can get just a tiny little bit of inflation to where, man, I got to buy that product because it's going to be 1% more expensive or 2% more expensive a year from now, that kind of forces you into action versus now or what we told last year, which is, prices doubling in some places at the grocery store and really kind of going up 8, 10, 20% over 2 years. That's a big problem. But if you go, it goes up a little bit, it kind of greases the wheels. But deflation is something I think all central bankers have decided we will not let that happen. So to answer you and Jeff Gunlack, they're going to cut rates and do quantitative easing and anything they can to prevent deflation. So I think it is really hard to say we're going to keep it between 0 and 2, but they just want the tiniest little bit to motivate you to go buy.
Ask these guys how well that worked out for them from 2010, 2020.
It didn't.
You couldn't create inflation anywhere. That's my point being. It's like they don't have the right tool. No one knows what the right tool is, but they're just not going to be able to stop it at 2%. It's probably going to go really, really low, and it's going to become deflationary, and then we're going to be in the same position we were 10 years ago. In my opinion.
Yeah,
but
I think that's the kind of one to end on is we get to find out if this is just a political thing, because there is an election next year. And I think there's a lot of pressure on the Fed, as well as most people who are incumbents in Congress, to let's just keep this thing going a little bit longer. Let's not have it collapse until after November of 2024. Then if they all get reelected and everybody gets their terms again, okay, well, now we'll let it go because we got 2 years until the next election, or 4 years in some cases. So it's or 6 years if you're a senator, which is nice. But none of them want to be in the front of a election going into an economic disaster or a major recession. So I do think they're doing everything they can to let's just keep this thing on life support a little bit longer so we don't all get fired.
Well, I agree with you, and I think we'll end on this. We just got some breaking news from Nikki T. Just tweeted that the Kansas City Fed President George, she thinks that for the Fed to pivot, it's going to have to get closer to 3% than 4.5%. Which I should say that's not breaking news. That's what they've been saying. But
breaking tweets. How about that?
They're being very aggressive. They're almost talking too much. Where now it's just I don't think it's working. I really don't.
They all started to say different things.
Yeah.
So that's the issue.
Which just proves that they have no idea what they're talking about.
Well, that's why it's so hard to predict. They don't know what they're going to do, so we can't predict what they're going to do because there's nothing to read into it. It's not like, Yeah, it's not predicting sports scores where you go, oh, I like see this advantage here and this team's a little better. They don't have any idea what they're going to do, right? So
It's crazy. All right. Well, with that, we'll end it there. We'll continue. We'll continue our tax talk in a couple weeks on our next mid-month podcast. We'll come with some strategies and some. We get a lot of questions from clients, and they're very similar. Everyone's got the same questions all as it relates to taxes. So we'll come with some ideas and some strategies, and then next podcast will be our end of the month. So with that, thanks, Kevin.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.